Hey everybody, it's Ken and Danielle.
Hello.
And I'm here with Kevin again from Capital Fund One. Welcome back.
Thank you. Happy to be here.
Yeah, so you guys might know, you saw the show we did with them. They specialize in hard money lending. And since we did our last show, you guys are expanding across the U.S., huh?
That's right. Yeah, we're chasing those smile states. So staying in the Sun Belt. Most recent market that we've expanded into is Tennessee. We're adding Georgia kind of as we speak, getting things together there. And then from there, probably South Carolina and North Carolina. But current operations are in Arizona, Colorado, and Texas as well.
One of the interesting things is 2 years ago, somebody could have got a 24-month loan at probably today's prevailing rate. Isn't that interesting?
It's fascinating.
Yeah. So what has that done to your business? Because, 2 years ago, today's interest rates would have been considered hard money.
Yeah, I think when we spoke, I can't remember when that was, maybe Q1 of 2022, we were lending on average about 9%, but we were lending at interest rates as low as 7.99%.
Yeah.
I mean, 7.99%, that sounds like a conventional 30-year fixed right now.
I know.
So
Crazy.
Yeah, I mean, so there's a couple different, angles that the rising interest rates affects our business. But, I guess what the angle we should approach first is kind of how does that impact our operation? And the way that we're capitalized is we are a fund. We have a fund of about $450 million raised from private individuals, wealthy, high net worth accredited investors. And then we have an additional $300 million that we raised from credit facilities. So some bank credit facilities, some non-bank lenders. And that cost has obviously risen quite a bit.
Yep.
And that was a huge opportunity. Those credit facilities were a huge opportunity for us to be able to borrow at dirt cheap, 2 years ago on those credit facilities and lend it out. And that blended rate, that arbitrage that we created, we passed off, to the borrower in lower rates. And then also the investor was able to maintain a pretty healthy return as well. So that whole dynamic has changed. Our cost of debt has risen dramatically. So we've had to, of course, make adjustments to our interest rates. So rather than lending at 7.99 or, 9%, we're lending at closer to 11 or 12%.
Sure. So you just moved with the market, essentially.
We did. Yeah. And we're trying to toe that line as we want to make sure that our investors are receiving the yield that they expect based off of their perceived risk of their investment, and then staying as competitive as possible and being able to maintain or capture a little bit of market share in the operations, the lending side of things.
So I was going to ask you, you mentioned that there are certain states that are lender friendly, and you talked about the deeds and everything. Can you get into that a little bit more detail just to educate the audience about what that means? And because they can look for this too.
Yeah. So, I mean, the most important thing is the state deed of trust, is it judicial, and for example, in Florida, to foreclose on a property, you do have to involve attorneys, and it is a longer, more drawn out process as the lender to be able to foreclose on a property. In Arizona, for example, if a borrower goes 30 days past due without making a payment, we can send them a 10-day demand, and that 10-day demand gives them the opportunity to bring us current within those 10 days. If they don't, then we can actually file for a trustee sale date and start the foreclosure process. 90 days from that 10-day demand, or I guess 90 days from after that 10-day demand expires, we can actually take it to the trustee sale and foreclose on that property. So not every state is like that. Like I mentioned, those judicial states, New York, it's a very expensive, drawn out process to foreclose on a property. Problem with that is borrowers know, real estate investors, borrowers, just people in general, they understand where the loopholes are in any program.
Yep.
Right. So whether it's a government program or whether it's a legal process, it's pretty easy to figure out how you can get around servicing debt, for example. And it's just not a good piece that we would be interested in adding to our business model, because again, what we're trying to do is create the most competitive product for our borrowers, and we can't do that if yields to our investors are going to be inconsistent. right? If our investors are going to perceive that their investment into this fund is going to be going towards loans that could go, non-performing for over a year, we can't even foreclose on that asset, then they're going to expect a higher yield, right? The fact that we can provide them monthly, dependable, reliable, consistent returns is why they're okay with us not giving them 15% returns, because we don't, right? Our returns to investors are closer to 10%. And they're happy with that because they really understand the investment. So we try to make it really simple. And we're not going to really overextend ourselves. We're not going to ever be in 50 states. We're only going to be in the states that we know and we understand that foreclosure process. And again, it's not because we take back properties. Less than 1% of the loans we make do we actually take back those properties, which is a very low percentage. We've made close to 14,000 loans, and we've taken back 85 properties. So
yeah, I know it's a very small number. It's surprising, actually. It just shows how well that is, how well run your company is. So what do you see now? First of all, who's buying right now, and as you guys are expanding, so that's why I thought I was glad to have you back on, because I was like, you guys are expanding to new states at a time when the whole real estate industry is pulling back.
Yeah.
So what's going on?
When your customer base is more individual entrepreneurs and less institutional,
right?
They're always going to find opportunities.
Yep.
And that's what the business model is built off of, is, like I said a couple times, started in 2009 when, in that period, it's not like from 2009 to 2010 to 2011, 2012, there was consistent linear appreciation in the market. There wasn't. It was pretty, choppy. But people were able to take on projects successfully because there was opportunities, because they could find sellers who needed to sell. And that's the exact situation that we find ourselves in today, where when you have people who are motivated and they have the resources and the intelligence and the willpower to go out and find opportunities, they will. And there are tons of opportunities right now. I mean, when nobody's doing something, that's usually the time to do it, right? And
Completely agree with you.
we are closing on multifamily. I wouldn't say we're closing on large multifamily assets right now. I think most of the multifamily that we're closing on is in that 4 to 10 unit mix. So that's, our borrowers are finding opportunities to purchase properties off market at discounted cap rates. And they're putting some love into those properties. And then, they have a strategy to where everybody's kind of got a different mindset on how quickly they're going to exit these properties now and how they're going to do it. So they're comfortable that if they have to hold our loan for 24 or 36 months, if they have to extend a couple times, they can, because they're buying these properties at a discount. Again, they're not going to be buying Class A or even Class B properties necessarily at a discount. I'm sure those opportunities are out there. The ones that we're funding, the ones that we're looking at, are all in that Class C.
Because you guys do your own in-house appraisals, and you're very, very, very good at research. So walk me through that. What are you seeing on the housing market
Currently?
Yeah.
Well, currently, we are seeing some inventory levels rise, but that could be seasonal. Here in Arizona this time of year, inventory levels start to rise. But it just seems like inventory levels are very, very tied to interest rates right now. You have a lot of different cross streams that are impacting those inventory levels. Obviously, everyone always talks about the fact that, like 85% of conventional loans outstanding right now are at an interest rate of like 3.5% or lower. So who's going to put their home on the market right now? And where are they going to go if they do? So that's keeping inventory low. And then, obviously there's no demand, or there's not a ton of demand from buyers right now. So sellers know that. So even if they were comfortable walking away from that mortgage rate, everyone's thinking, the Fed is going to drop rates. They don't know when, but they're going to. And when they do, that's when I'll put my home on the market. So I think, we'd probably see quite a large spike when that does happen, when interest rates drop a little bit. But right now, it seems like in January, the bleeding kind of stopped. Inventory levels started dropping pretty significantly. Here in the Phoenix metro, we went from a little over 20,000 units active on MLS down to, I think, 11 or 12,000 in just a matter of a couple months.
Yeah,
That's a pretty dramatic drop in inventory levels, and we've seen some appreciation in the markets. Arizona is actually probably the market that, of the ones that we're in, Arizona, Colorado, Texas, and Tennessee, experienced the largest level of depreciation and probably the lowest level of appreciation in 2023. The other markets, Texas, Colorado, and Tennessee, have actually experienced even lower inventory levels and higher appreciation over these last 9 months.
Kevin, what's the best way people can reach you?
Yeah, so I mean, you can always go on our website, capitalfund1.com. We'll also include a link in the description here that's going to have a landing page. So if you want to get in contact with us quickly, you'll be able to do so through that link. But you can follow us on Instagram, again, capitalfund1.com, and we're always putting out some content. If you're in any of those markets, we do quarterly events in each of those markets, so feel free to come out and network and meet other investors and other professionals who are in the industry.
Yeah. Well, I appreciate you coming in today. This has been a fascinating discussion.